Hello guys, welcome to Bearbull, and in this video lecture we'll be talking about a very important concept in economics and finance, and that is called arbitrage. Now, what is arbitrage? Well, simply put, arbitrage simply means buying an asset in one market and simultaneously selling an identical asset in another market at a higher price. Remember the catch, we are buying and selling identical asset. For example, if we are buying the shares of, let's suppose, Nestle, then we are also selling the shares of Nestle. That is, the assets or the stocks are identical. The second catch is that we are buying and selling simultaneously. That is, there is no gap or time lag between buying and selling, because that would make it riskier. And arbitrage is essentially, as we will see, is that we are making risk-free profit. The third scenario is that the third catch or the essential ingredient of arbitrage is that we are selling the asset at a higher price and buying the same or identical asset at a lower price. For example, if we are selling the stock of Nestle at New York Stock Exchange, we are selling it at $105, and we are similarly will be buying the same stock of Nestle on London Stock Exchange for $100. We will see the example of arbitrage in the next slide. So for now, just remember this definition. Moving on, example of an arbitrage transaction. Suppose that you have 10 shares of Nestle trading on New York Stock Exchange. Now you want to make some risk-free profit. Okay, some risk-free and instant profit, but you also want to keep those 10 shares for you, or the 10 shares of Nestle. Now, in this example, how is it possible? Just pause the video and think for a moment that, okay, how we can make risk-free profit and still keep the 10 shares of Nestle. Well, you can sell the 10 shares of Nestle at New York Stock Exchange. For example, if the shares are trading on New York Stock Exchange for $105 and simultaneously the shares are trading on the London Stock Exchange for $100, what you can do is the shares which you have on New York Stock Exchange, you can sell those shares for those 10 shares for $105, and then you can simultaneously buy 10 shares of Nestle on London Stock Exchange, because shares are trading at a cheaper rate on London Stock Exchange. So you have made a profit. You have sold the shares at a higher price and bought the shares at a lower price. So you have made essentially $5 risk-free profit, because you still hold 10 shares of Nestle. Now, why is it risk-free? Because you have made a profit, but you still have those 10 shares of Nestle. Your profile or your portfolio hasn't changed. You are exposed to the same risks which you were earlier, but in the meanwhile you have made $5. So that's a very good trade. You have made $5 and without losing your shares or money. So, but is arbitrage possible? I mean, if that's the case, then people, especially those in the stock market, might become rich overnight. But there are certain limitations to it. For example, in the recent years, opportunities for arbitrage have decreased manifold, or some people say that there is no such thing as pure or risk-free arbitrage because of the globalization of financial markets and efficiency in the markets. Because there is not a very good probability that the stock of Nestle, or the 10 shares of Nestle will be trading at New York Stock Exchange for $105, and they will be trading at a cheaper rate at the London Stock Exchange, because today all the share trading is online. So if shares are trading at a higher price in one market, all of a sudden people will sell those shares and buy it on the other stock exchange on which the shares are trading cheaply. So that would effectively change the demand and supply of the shares in the both stock exchanges, and the share prices will reach an equilibrium, probably somewhere middle point, that is $102. The shares will be trading at $102 in the both markets. So some would say that the opportunities for pure arbitrage have vanished from the current markets, which are very efficient, which reflect the prices or the performance of the companies very much similarly. So what people do is that they tend to do a slight tweak in the arbitrage. What they do is that, for example, you can say that if there are two companies, and let's suppose Coca-Cola and Pepsi, and their shares are trading at a differential price, what they will do is that, for example, they can sell their shares in Coca-Cola and buy the shares in Pepsi, and in the meanwhile they will make a profit, of course, risk-free profit, provided that their share prices are different. But they will be, both the stocks of the both companies are exposed to same sort of risks, that is, both are beverage companies, but they won't be 100% identical shares. Let's suppose that the financial statements or the balance sheet of Nestle, the financial statements of Coca-Cola are not that good, then the person will be exposed to a more risk when he buys the shares of Coca-Cola. But having said that, there is still opportunities for very smart arbitrages. But identical arbitrage has essentially vanished from the market. But in order to know the concept, you have to keep in mind that arbitrage is essentially buying and selling of identical assets simultaneously, and number three, in the different markets. So these are the prerequisites of arbitrage. I hope this video helped you in understanding the concept, and if you want to know more about concepts on economics and finance and business and business ideas, just subscribe to the channel. Thank you so much.